Hello, good evening. Tonight on Business Live, banks begin releasing their 2022 financial statement ahead of the April 30th deadline by the Bank of Ghana, but domestic debt exchange program impacts negatively on their profitability. Also in this bulletin, Ghana's net international reserves will end 2023 at nearly 3 weeks of import cover. That's according to the 2023 International Monetary Fund Regional Economic Outlook Report. We will hear from an economist on the possible implications.
It will trigger speculative activities on the market in the coming days, really. And if care not taken, we might reverse some of the things we are seeing on inflation if the trend continues as we are expecting, really.
Plus, Ghana earns the World Trade Organization's praise for rapid development in digital trade. We'll hear from the Director General as she begins her Africa tour from Ghana.
Digitally delivered services are growing fastest, and in Ghana it's doing quite well from the numbers that we can see. So this is an area I want to encourage Ghana very much.
We've lined up details of these and many others shortly for you. Grateful you could join us. I am Pious Kojo Baka. To our very first story, banks in the country have begun releasing their 2022 financial statement ahead of the April 30th deadline by the Bank of Ghana. But the domestic debt exchange program has impacted negatively on their profitability position. The following report has more.
According to the audited financial statements cited by Joy Business, almost all the banks that have published their statements recorded losses. Standard Chartered Bank is one of them, as it recorded a loss of 66.4 million cedis. This is despite a staggering 807.7 million cedi interest income recorded in 2022. The Tier 1 Bank, however, recorded a bad debt of 1.18 billion cedis last year. Similarly, Republic Bank registered a loss of 66.8 million cedis. It posted a net interest income of 370.6 million cedis, but a 237 million loss on financial assets and other costs triggered a negative position. Parent companies of First National Bank, Stanbic, Zenith, and Guarantee Trust Bank have already hinted of significant losses by their Ghana subsidiaries due to the impact of the domestic debt exchange program on the operations. Many investors should therefore not expect dividend payment for this year. Meanwhile, Societe Generale Bank is one of the few banks that recorded a profit in 2022. The bank, which was less exposed to the government of Ghana bonds, registered a profit of 110.6 million cedis. Joy Business had earlier reported that banks in Ghana lost about 15 billion cedis in 2023 due to the debt exchange program.
All right, so Senior Finance Lecturer at the University of Ghana Business School, Dr. Benjamin Amwa, joins us via Zoom for his perspective on this matter. Grateful you could join me, sir. Now, according to the 2022 audited financial statement we've cited, almost all the banks have published their statements recorded losses. That's appalling, to say the least. Kindly unmute for me.
Thank you very much. Yeah, it's appalling, you can say that, but then again, it is basically a reflection of the portfolios that the banks have created over time in their attempt to generate income for their shareholders. Clearly, these banks have heavily been impacted because they expose themselves to the government of Ghana bonds, which we know now has been risk-weighted by Bank of Ghana to be 100%, meaning that the cash flows from these bonds are impaired. Hence, these banks have to write them off through their income statement. And that is what is translating into the losses that these banks are recording and posting to the public now. So, indeed, it is appalling when you want to look at it from the fact that the banks were mostly generating their income from investment income through government of Ghana bonds, instead of doing more of lending to the private sector.
Interestingly, Societe Generale, which of course is one of the banks, have recorded a profit of about 110.6 million in 2022. What could be accounting for that?
So many factors can be attributed to this. One, it could be their business strategy. Two, it could be their income generating capacity in terms of how diversified they are from their income generating assets. Clearly, if you go through their income generating assets, realize that they have not heavily exposed themselves to the government of Ghana bonds. And that may have contributed to the less exposure that they had from the domestic debt exchange program. That is what has translated into the remarkable performance of SG. But then for the rest, that heavily conducted business with the government of Ghana, they have to face the heavy difficulty of having to record these losses. So clearly, it is the business strategies of the bank that are coming out to play now. And if I may add, you see, what is showing us is that our banks have not been doing much when it comes to lending to the private sector.
Okay.
Our banks have comfortably transacted business with the government, where income from government bonds or government instruments is what has shored up their performance. In a proper intermediation environment, one would have expected our banks to have done more of private sector lending if we are to support the private sector. But then again, like we all know, the private sector is risky. So the banks take the conservative approach to do business with the government. Unfortunately, from what we are seeing, it has not worked this time around. Hence, what we are seeing from many of the banks in terms of the losses that they are posting simply because of their exposure to government of Ghana instruments.
Now, the last time we had an engagement on this matter, banks were given a maximum of about 4 years by the Bank of Ghana to restore the minimum paid up capital. Juxtaposing that to the latest development, what could be the impact?
The impact is that banks definitely will have to show up the capital, and it is very possible that the central bank may have seen this before we have seen it. Hence, they came out with that directive giving the banks the next few years ahead to show up their capital. It is not surprising because in an environment like this where you have incurred losses, it is your capital that absorbs the losses. Once your capital will absorb the losses, you have to add that to your capital to get to the minimum threshold that you need to be comfortable to run your banking business. So what is happening now is all losses that are being recorded now will have to be absorbed by the bank's capital. If there is any shortfall, then just like the central bank is saying, the owners of these banks will have to increase or bring in more capital so that the banks can be comfortably capitalized to do their business. But then the bigger discussion should be, is the 400 million minimum capital still enough, looking at the environment that we find ourselves in? Clearly, the 400 million, if you ask some of us, it is not enough. The banks must contribute more than 400 million if we are to have a resilient and a strong banking sector, considering the macroeconomic environment that we find ourselves and the vulnerabilities that the debt exchange program has exposed the economy to.
Dr. Amwa, I'm wondering what the future really holds for our banks amid this debt exchange program.
Clearly, the future is not that bad. The future is not that bad, considering the fact that we have the Financial Stability Fund that is available to provide liquidity. And again, to think about the fact that the central bank has made it clear that we are going to have some 3-4 years for banks to prop up their capital. Clearly, it is a path that still brings in enough confidence in the banking sector space. So we should continue to do business with the banks, but just that our banks will have to be more stronger going for in terms of their capital to be able to support. And this time around, it is all clear that the government that we do business with, the government can fail. So the banks will have to think of how best can we diversify our portfolios so we don't overly expose ourselves to the government going forward. It is not, after all, bad doing business with the private sector from the experience that we are seeing from doing business with the bank, with the government, sorry.
And you believe there are still options for them to, diversify their portfolios?
Yeah, they have to think deep and think deep again. It will be difficult because you always be constrained by the fact that there's a government available that can give you good money and good returns. Nobody is saying that banks should not continue doing business with the Treasury. The banks will still have to do business with the Treasury, i.e., the Ministry of Finance. But the banks, from this experience, the banks will have to think about other strategies to rake in more income. Look, the private sector has been complaining about lack of loans, enough loans to do business. I think this is an opportunity for the banks to rethink and to do business with the private sector in terms of loan extension so that we can prop up the economy. Because already the economy is at a low level. So to turn it around, the private sector should be given another look by these banks.
All right. Thank you very much, Dr. Benjamin Amoah, for your time here on Business Live. He is a senior finance lecturer at the University of Ghana Business School, helping us appreciate the latest development. A while longer in the financial space, and Ghana's net international reserves will end 2023 at nearly 3 weeks of import cover. That's according to the 2023 International Monetary Fund Regional Outlook Report. Well, this is contrary to the Bank of Ghana's summary of economic and financial data that put the country's reserves in 2023 at 2.7 months of import cover. Again, the report said Ghana's reserve stood at a little above 2 weeks of import cover in 2022. Speaking on the marketplace, economist and research lead at GCB Capital, Courage Puti, shared some implications this could have on the economy.
It has been precarious for a while, and I've been on record saying that the CD is stronger this year than the fundamentals suggest. And the reason I say that is that we started last year with reserves in excess of $9 billion, but we saw the CD depreciate by over 45% last year alone. So for us, something this year with a funda or just $6 billion in reserves, it suggests the reserve support is even much weaker. And if you look at it on the net basis, it's just about 2.5 or so billion thereabouts. And so the fundamentals or the reserve support is even much weaker. But we've seen this year that on the retail market, the CD is doing just about 2% depreciation really. And that has been due to some sharp correction over the last few weeks or so. On the interbank market, it's about 21% depreciation. But compared to what could have been, and given the very weak external balances that we have really, I think the CDs are performing what the fundamentals would suggest really. And that probably is because the usual pressures you see from portfolio reversals last year, you are not seeing much of it this year. And the reason is the bond market is just inactive. And so those offshore guys who would want to move out do not have the space to even sell to move out. We've suspended interest payments on external debt really. And we've had a number of Eurobond coupon maturities falling due really. And government hasn't honored those because of the temporal moratorium in place really, or the suspension in place. So all of these have helped us maybe stay afloat a bit, but otherwise our reserve cover is actually very alarming. And the finance minister wasn't wrong when he said that if we do not get a program by March, the economy could collapse. We haven't seen that yet because some of those interventions have helped to some extent now. But I think this is time for us to do whatever we can to get a program running and at least get a balance of payment support going. And this revelation could actually even trigger speculative activities on the market in the coming days really. And if care not taken, we might reverse some of the things we are seeing on inflation if the trend continues as we are expecting really.
All right, so it is important we have to expand the conversation on the bank's profitability, which we've seen some decline in that regard. And joining us on phone is Professor Godfred Bobkin, who has joined us on phone to share his perspective with us on the matter. Grateful, Prof, you could join us on Business Live. Certainly, Dr. Amoah indicated that it is appalling to see, banks' profitability, dropped as a result of the domestic debt program. Your thoughts on that as well?
Yeah, well, I think that it's largely consistent with our expectations. We have said this long ago, way back last year. We had said that even before government officially considered that our debt was unsustainable, the projections were clear, and government was operating behind the knowledge curve. Okay, so now the reality is out there for everyone to see. Actually, hello?
I'm here, sir. I can hear you.
Actually, the losses you see the banks reporting is actually lower than what it should have been. And the reason is that because Bank of Ghana effectively suspended the application of the International Financial Reporting Standards, especially IFRS 9, IFRS 13, and the rest of them, we ended up using a lower discount rate, essentially ranging between 15.67% to 21%, which is actually lower than the market interest rate that the IFRS demands that we apply. If we had used that, then the losses would have been in excess of 80%. Now we are accommodating losses in the range of up to 40-41%, and that is what you see that it looks more presentable on the books now. But if they had recorded and applied the standards as the Banks and Special Deposit Institutions Act specifies, right? I mean, it would have been scary. It would have been scary.
I see.
And I still maintain that Bank of Ghana regulators failed the banks and they failed Ghanaians.
Now, let me pick your thoughts on this latest as well, where we do know that our net international reserves will end 2023 nearly 3 weeks of import cover. And this is contrary to what the Bank of Ghana had published. How do we reconcile the two? Does it come to you as a surprise as well?
We've had a problem in this country when it comes to general accounting system and reporting of data. Now, I'll give you two more instances. Until the IMF applied their debt sustainability framework, Ghana's public debt was a matter of multiple choice. Depending on which party you belong to, Bank of Ghana had one figure, government had another figure, the opposition had another figure, even academics, based on our own calculations. So, end of 2021, when check from Bank of Ghana data, when they were talking about debt to GDP ratio less than 76% or so, we were far above that. Okay? So, and that is one big problem within our public financial management space. That to what extent can we rely on the data that comes out from government sources? The other bit is to look at Bank of Ghana's own official exchange rate. You can't refer to that rate as a transaction rate because dollar is not clearing at that particular rate. Okay, so when we do all these things, we're actually not helping the market because one important function of the market is price discovery. Of course, we know that when it comes to our international reserves, it's not the first time. In fact, in 2014, the central bank had a dispute with the international community as well, including the IMF, because in 2014, our reserves on net basis could only cover 2 weeks of imports, only 2 weeks. Meanwhile, at that time, Bank of Ghana had data that suggests that we could do more than 1 month. You can check the data. And the explanation then, and I believe it will not vary now, is that probably they are looking at reserves on gross basis where they also include the heritage fund and all of that. And probably the fund may be looking at reserves on net basis. And also in terms of the denominator, they are looking at both import of goods and services, and one will only talk about import of goods and all of that. But that's not the only thing. Do you remember that somewhere last year, I think middle of last year, there was the issue of Bank of Ghana monetizing the deficit and printing and sustaining the government? The central bank denied that. But what do we see today? If you check the latest figures, right, you will see that Bank of Ghana's overdraft facility to government, everything put together, is over 77 billion cedis. So, probably in a little over a year, the Bank of Ghana has given Ghana government more money than we could get from the IMF over a 3-year period.
All right. So, Prof, I want to pick your thoughts quickly and provide us with some solutions. How do we shore up our reserves now? Because the indications coming in from the Bank of the World International Monetary Fund really is nothing to write home about.
Yes, no, right now, look, the stability we are seeing is not anchored on the fundamentals of the economy. Generally, the economy is on suspension. We've suspended the economy. There is very little happening right now. It's part of why you see there's very little movement. You see general slowdown of economic activity. You see the traffic from the port going down. You can also see that intentionally, the budget execution of the 2023 budget is very low. So therefore, you are not really seeing economic activity that should drive price movement in the market.
Okay.
And we have said that where we are is quite precarious. Okay, so probably, and as we first said, we needed IMF program like yesterday. Great news. But we have also said that the IMF program will not be sufficient in addressing Ghana's problems.
Okay.
And that is what the fund is actually telling us, that even if the program kicks in this year, our reserves will not increase substantially over the next 12 months or so. So if you look at their projection, even after 2024, it's not going to increase that much. Because if you look at how much we can get in terms of balance of payment support from the IMF in the first year, 1.5 years, I mean, it will not be enough to move our reserves to, let's say, 3 months import cover or so.
All right.
But then, by the time the program ends, the target is that our international reserves should reach maybe 3 months import cover. But what that would mean is that Bank of Ghana may not have the flexibility of using the reserves to fight the volatility,
Okay.
which means that the fund is likely to allow variation in the exchange rate in order to preserve international reserves and the macro outcome in terms of the number of months of import cover.
All right. We are indeed grateful, Professor Godfrey Bobkin, for your time here on Business Live. A reminder, you're still watching Business Live. Now, Ghana has been praised for its rapid development in digital trade and friendly environment for women entrepreneurs. According to the Director General of the World Trade Organization, Dr. Ngozi Okonjo-Iweala, the country has made significant progress in ensuring that businesses thrive through digital channels. The following report has more.
The organization has acknowledged the easy movement of goods through supply chain management and the drive for digital trading among member nations. According to the Director General, Dr. Ngozi Okonjo-Iweala, the WTO is working on many regulations to accommodate the new trend for fair business competition. She applauded Ghana for the successes in making digital trade thrive. Speaking on the importance of the Continental Free Trade Agreement, she urged government and business community to focus on value addition to gain more from their exportable products.
There are some other exciting areas of work at the WTO that I just want to touch on. I'm very happy that today we'll be meeting small and medium enterprises, especially women who are engaged in digital trade. One of the most exciting happenings in the world today is the rise of digital trade. Digitally delivered services are growing fastest, and in Ghana it's doing quite well from the numbers that we can see. So this is an area I want to encourage Ghana very much. Digitally delivered and traded services in Ghana are doing well, whether it's, what professional services from business outsourcing, trading, intellectual services, and back office functions with others, or digital trade of women. There are many women I can see, and also men, who are trading here on the internet, and that is growing very, very fast. We are trying to develop rules at the WTO that will guarantee fairness and predictability for such trade.
The Minister for Trade and Industry, Kobna Tahir Hammond, wants the restoration of a fully functional two-tier dispute settlement mechanism at the WTO. He believes that this will enhance transparency in international trade.
And hence the rules-based for world trade to develop. But I have been concerned to learn that you have no proper adjudication system because somehow the appellate system is collapsed. You only have the first tier tribunal. We cannot have a system of this magnitude when we don't have a forum where arbitration of disputes, which inevitably would arise to be resolved. I'm told that you tried very much to get this matter resurrected. So our hope is that by the time of the 13th ministerial conference meeting, if we have been able to do the condition precedent, we will be able to come over and make sure that these matters are properly articulated. But I'm told that because the appellate one is collapsed, the first one is completely dysfunctional and nothing at all is taking place.
This is the maiden African tour of the WTO Director General since she was appointed to the position 2 years ago. The visit is also used to lobby Ghana to ratify some of the ongoing new regulations on international trade at the upcoming 13th Ministerial Conference in Abu Dhabi next year.
Thanks so much for being part of the bulletin. I am Pious Kojo Baka. You can always get business stories when you log on to myjoyonline.com/business. Let's connect same time tomorrow. Bye-bye.